Investors' perception of a Fed pivot helped power the rally into year-end. But should they worry about an economy still digesting the lag effects from the hikes of the past almost 2 years now? Joining us now is Torsten Slok, Apollo Global Chief Economist. Torsten, great to have you back on the show. We're going to start right there with that question because I know you've been mulling it and putting research together around it.
Yeah, no, and I think the critical thing really here is that should we put weight, exactly as you're saying, Morgan, on the fact that the Fed has been tightening credit conditions and raising the cost of capital for a very long period of 18 months up until what happened in December. That would all argue for a slower economy over the coming quarters. That is still what the consensus is expecting. That's still what, broadly speaking, we have been hearing from a number of different analysts in terms of what's coming in 2024. But I think what is very important in that discussion is now to begin to put weight on trying to quantify, well, what are actually the implications of the Fed pivot? Chris Waller, the FOMC member, said in November that the easing of financial conditions that came in the second quarter after Silicon Valley Bank, that was enough to create 5% GDP growth in the third quarter. In other words, a boom in the economy. So why wouldn't we now today come to the conclusion that the pivot that we saw in December is likely to also begin to create a boom, potentially in the labor market, lower rates, also in the housing market, and all that is just complicating a lot the Fed's path of getting inflation back to 2%.
So we've seen a Fed pivot. It's loosened financial conditions. And what you're saying now isn't soft landing, but the possibility of no landing.
Yeah, I think that the pendulum has simply swung too far, because if you put into the Fed's own model of the U.S. economy, FERBUS, and try to quantify what does it mean for the U.S. economy if you have a 100 basis point cut in the Fed funds rate? What does it mean if credit spreads on IG tightened by 60 basis points? What does it mean if you had $20 oil prices? And what does it mean if you have one standard deviation less in VIX? All that means that GDP growth over the next several quarters could grow as much as 1.5 percentage point more than what it otherwise would have done. So I think the key risk going forward is that the housing market is already showing signs of a recovery. We saw last week a 5% increase in Case-Shiller. Remember, housing has a weight of 40% in the CPI index. If we have both housing beginning to stage a recovery, at the same time, the labor market is still tight. We saw ADP today. We saw also jobless claims. Still no signs of a strong slowdown. All that argues for potentially also wage inflation, according to the NFIB, also getting some tailwind. So housing and wage inflation taken together, the risk is, Morgan, to your point here, that we might actually get a swing back to the almost no landing scenario, where we begin to see more risk that the economy is just not slowing down the way that the Fed wants it to.
So it sounds like you think no cut in March, maybe not more than 3 cuts overall. Is that priced into equities?
Well, I think, first of all, that I think the market in rates is getting way ahead of itself. So for futures, exactly as you're saying, are pricing 6 cuts. So I think we are more into the camp of 3 cuts, of where the Fed is probably right that we will get a slower pace of cuts relative to what the market is saying. But to your point, I think for equities, the risk really is that the pendulum for this Fed has swung from hawkish last year to now suddenly swinging over in a much more dovish direction after the pivot. And now I think that the pendulum will begin to swing back towards having to be more hawkish, because we're simply not out of the woods. Several FOMC members have come out and also said this after the pivot meeting, saying, no, this was overinterpreted by the market. So I think the Fed is trying to anchor expectations at 3 cuts. But I do think with that will come more downside risk to equities as a result simply of that we are just not out of the woods when it comes to fighting inflation.
So what are the risk assets that you see that have particularly gotten ahead of themselves at this point?
Well, I think that the stock market, in particular tech, growth, venture capital, things that have really gotten a significant tailwind as a result of the Fed pivot. You have also seen in the last few days significant IG issuance, significant high yield issuance, a lot of emerging signs of credit markets really coming back to life as a result of the pivot. And I think all that is tailored to essentially provide a boost to growth, and is at risk of providing a boost that's so significant that we might again come back soon and talk about the economy. And we'll see the employment report tomorrow. The forecast from the consensus is just below 200,000. That's not a bad economy. So if we do get still a labor market that's strong, if we do still get a rebound in the housing market, which is already playing out as we speak, I do think that the Fed will have to step back to the more hawkish tone as we get through the next several months.